Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham. This is episode 20. And on today's episode, we're going to follow the bouncing ball that is the stock market, this up-down movement that we've seen the past couple of weeks, the market searching for direction. We're also going to discuss the question, get rich quick, ? I'm Ron Burgundy. Is it possible to get rich quick? What are some of the schemes of the past, and how do we as individuals get roped into them? And we're also going to look at alternatives to this. Are there ways to avoid that and not have to mess with it? So I hope you'll think about your goals, think about the disciplines that it's going to take to get you there. And as always, let's get to work.
You dropped this.
Well, let's take a look at the market this week. So, as we discussed in previous weeks, we have this political football that is the debt ceiling that continues to kind of stir the market up and stir the market down. As they get closer to a deal, it goes up. As they get further away from a deal, it drops. And so you just have this continuous issue that we're dealing with here with the debt ceiling. And so Congress, the Senate, came up with a plan, I guess, to delay it for a month or so. And so you just get this initial relief in the stock market, but eventually we're going to have this problem again in 6 weeks. And so Jamie Dimon, who's the CEO of JP Morgan, came out and said, hey, why do we even deal with this? Why do we deal with this debt ceiling? Because years ago, I believe the year was 2011, we kind of had this contentious battle within our political ranks to raise the debt ceiling, and the stock market sold off 10% because of it. There wasn't anything going on with the companies. There wasn't really any issue. It was just the debt ceiling. So at some point, you start getting cries of manipulation and what's going on. Why do we have to do this every single year, right? So it is something that needs to be addressed. But what ends up happening is they pass a debt ceiling, they raise the debt ceiling, and then we just kind of move on to the next problem. Nobody ever reflects back on, hey, what can we do to maybe prevent this from happening in the future? So, but there were some good points in the market this week. One of the ones that I noticed was Netflix. Netflix had a really good week. Netflix started the week at $597 a share, jumped to as high as $640. In the past month, it's gone from $569 to right now it's at $632. A lot of this is off the popularity of their new show Squid Game, which I haven't seen. Spoiler alert, haven't seen it. But I know that there's reports that they're getting many international subscribers because of it. So it will be something to watch. There wasn't a lot of content made during the pandemic. And so a lot of these entertainment companies are looking for different things to be able to be able to post, to be able to show. And so having a big global hit like this for Netflix is going to be a pretty big deal. In other news, there was a report on Alibaba, which we have talked about previously. There's a big buyer for Alibaba, and the big buyer is Charlie Munger, right? Charlie Munger, who sits over my right shoulder supporting the Cubs here in my office. So Charlie Munger buys a number of shares of Alibaba. I think it was close to 44 million, which caused a lot of headlines because, hey, Charlie Munger is a great investor. He's doing this, he's buying this, but there's never any context when you see one of these big investors investing into a company. And so I'll caution you that even though the numbers sound big, you got to figure out what the math is on that to figure out what that percentage really is of their net worth. So Munger's worth around $2 billion or so, and that $44 million purchase represents about 2% of his net worth. And so you might remember on a previous episode where I said, if you're going to invest in something, you need it to be about 2% of your net worth. Otherwise, you're not going to be able to feel it, whether it goes up, 100% or if it drops. I mean, you need to be able to invest enough or get up to a point where it's at least 2% of your portfolio so that it can have some kind of impact. And so with Munger, I thought that was funny, although the size of that sounds a lot bigger. I mean, it makes a huge headline because of who he is and because of the dollar amount. It's a massive amount for anybody, but for him, it really only represents 2% of his portfolio. So, for example, if you had a $100,000 portfolio, this would represent $2,000 of that portfolio of yours, right? So, something that many people who had a $100,000 portfolio could definitely manage. But it does create a lot of headlines, get some interest back in the stock. Alibaba has not had a good year because of some of the Chinese regulations that have come into play that we have discussed. Alibaba started the year at $236 a share, and right now it's $161. So they have not had a good year, and they hit a low of $144. So it is something to maybe consider. But again, you'll have to look at your own financial situation. I always forget to say this, but remember that this podcast is for entertainment purposes only. I am not your financial advisor. So please consult your financial advisor before making any decisions. Do your own research, and past performance is not indicative of future results. So we see that in the market this week. Tesla made headlines and announced that they're going to move their official headquarters to Austin. So that is a kind of a blow for California. We'll see what ends up happening for that. And that's something that I don't think anybody was really shocked by that. They had made plans to build a plant there and had been moving on that. So it kind of seems like that was something that was in the works. I think Elon Musk was doing that to see if he could get some more concessions or something from the state of California. It didn't work out, and so he ends up pulling the trigger. One of the big stories this week has been Facebook. And so last week, Facebook made the news, not in a good way, with a whistleblower employee discussing how Facebook knows some of the things that they do cause harm, some of the social media stuff that they have. It's kind of a touchy subject, obviously. There's been different people that have come out. Mark Benioff, who's the CEO of Salesforce, at one point said that he thought social media was going to be the nicotine of the younger generation, which is a very hardcore statement to make. And, when you think about, all the time spent on our devices and all the things that are that are done to try to keep us on those devices, one can make a point for that. So, obviously Zuckerberg came out and said, hey, no, that's not true. We're doing everything we can to be, helpful to people or whatever the case may be. But that is going to be something that is going to keep coming up, right? We've seen this with Facebook with election material. We've seen it with, with this and the platforms being damaging to teenagers or whatever the accusation could be. Facebook had some problems this week with outages. I think it's because I got one new follower on Instagram, maybe. Maybe that was the cause of it. But yeah, so, when you're looking at this, when you look at Facebook, this is one of those times where when you look at this company, as far as their financials, you look at their balance sheet, you look at their income statement, man, it's really, it's clean, man. This is a profitable company, not a lot of expenses. These are the kind of companies that you look to invest in. They, on paper, they look really good. But the problem is you start having these other types of risk, right? So you have the risk of, Zuckerberg. You have, the risk of their product. Maybe there's more information, more studies, more legit criticisms that come out where they show that this could be damaging to younger people as they're developing and they don't understand the difference between what's real, what's not real, all these kind of things. And, the jury is still out on this, and it's going to be an evolving an evolving issue. Will people regulate it? Will government have to step in and issue regulations on them? What regulations would those be? And so that is the risk you take when you invest in somebody like Facebook, right? And it's not just Facebook, right? We got to acknowledge that Facebook owns Instagram, they own WhatsApp. And so, it's bigger than just Facebook, but this is something that is not going to go away. And if you invest in Facebook or you're thinking about investing in Facebook, this is one of the things that you need to consider. Because since this story has come out, Facebook, in the beginning of September, hit a high of, well, I don't know if this is the exact high, but 382 a share. It's already back down to 330. And so obviously that's a little bit because of the market drop. We've had a little bit of a correction here, but also this kind of picked up momentum when these stories came out. So it is something that you need to be thinking about when you invest in some of these companies. Is not just the risk of the numbers and all the financial stuff that goes into it, but what are the other things that you're going to have to maybe factor in that are more company specific. By the way, doing a little recording this week, some video to go along with the audio. We'll see how it works out. I need a better setup, so I'll apologize in advance. It's going to be pretty raw. But that being said, we'll see how this thing evolves. We'll see how this thing evolves. You're going to notice a lot of different marketing and more posts and things like that. So I'm getting a lot of really good help from some really good people that I'll highlight later on. But you'll start seeing their work and let us know what you think. With that being said, so the main topic of today's conversation is this get rich quick, question mark. Is it possible to get rich quick? And of course, obviously it is. Somebody wins the lottery, somebody does this, somebody, there's always these stories. You're always going to hear the stories. You're always going to hear the stories of the people that win lotteries, the people that hit it big. And that's what causes us to always have dreams of this. So I just wanted to give you a little history lesson of different market bubbles that there have been over time, and see, you've probably heard of some of these, but in the 1600s, there was a tulip bulb mania that came out where people were buying and selling tulip bulbs. And the reason they were buying these tulip bulbs, like why did they care, is because they changed colors. And people love the fact that they changed colors. And so you see this, you see these tulip bulbs start to take off. It's the same thing that you always see. They take off. You have a little bit of a sell-off. People come back in, they buy. You get some media attention. Then you get enthusiasm. And then greed comes into play. And then you have, at some point, delusion. And then all of a sudden, these things crash back down to reality. And this is in the 1600s. Keep that in mind, the 1600s. So why did these tulip bulbs change colors? Well, one of the things that happened is they started planting them. They started dying really quickly. And they figured out the reason they were changing colors is because they had a disease, right? Hard word for me to say for some reason today. But they had a disease. And so, it was a horrible thing. The flowers didn't last, and then all of a sudden they sold off. Sir Isaac Newton invested in the South Sea Company. And of course, Isaac Newton, one of the smartest people that ever lived. This is the 1700s. He invests a little bit. He exits his trade, makes some money, right? He exits his investment. He makes some money. All of a sudden, his friends start to get really rich. He re-enters at the high. And then all of a sudden, it comes crashing down and he exits the stage broke. He exits broke. And so what happens? Why do we get trapped into this? Why do we always want to do this? Well, I don't think anybody puts it better than Warren Buffett, who again is over my right shoulder here. But Warren Buffett says, people start being interested in something because it's going up, not because they understand it or anything else. The guy next door, who they know is dumber than they are, is getting rich and they aren't. And it drives people crazy. So when we see other people making money, when we see other people, quote unquote, getting rich, all of a sudden we think, man, I can do that. I should be doing that. I don't know what this is about, but I'm gonna start doing it because other people are doing it. It looks easy. I've seen some YouTube videos on it, and sure, I don't know what Forex is, but that's for me. And so we just kind of get going, and all of a sudden it starts to become riskier than we think it is. And that's really, something that we have discussed is you start taking on more risk than you realize that you're taking on, right? And so, that's these bubbles have always happened, and they're always going to happen because of human nature, right? I had somebody this week tell me I bought, I don't know what it was, a million of some crypto. I can't even remember the name of it. And it's worth 0.00088. If it goes to a penny, I'm going to make this much. And if it just goes to $1, I'm going to make $80 million. And I'm sitting there going, okay, well, in my mind, I'm like, okay, first you got to get it to a penny, and then it has to go to $1. Do you know what percent increase that is? It's massive. It seems little because you're going, oh, it just has to go from a penny to $1. That's not that far. But honestly, it really is. It's 100 times, right? It's 100 times. And so we just get caught up in this illusion that we're going to be able to be able to make money quickly and to be rich. And honestly, there's a difference between being rich and being wealthy. Rich can be somebody who makes a lot of money, could be quickly, or maybe they make a really good income, but maybe they spend it all. I want you to be wealthy. I want you to be wealthy. Wealthy is when you're making money while you sleep. You don't have to have any kind of activity going on for you to still have money, right? Your investments are kicking off money for you, and that's wealthy. You want to be wealthy. You don't want to be rich, right? So you have to start thinking about that. You have to start making that decision. So how do you do that? So today's investment topic, today's investment, lesson is in something called dollar cost averaging. And I'm just going to prepare you. I'm just being honest. It's boring, right? It's not something you're going to see highlighted. There's not going to be a ton of YouTube videos. There's not going to be a lot of, these little snippets where somebody's going, oh man, I got really wealthy doing dollar cost averaging. It is not going to happen. I will burst the bubble right here. That is not going to happen because it's slow, right? Investing, to be good at investing, it's almost, you got to have like anti-activity. The less activity you do, the better, right? Maybe like barbecuing, right? Low and slow. So dollar cost averaging is where you start taking, right, $100 a month, $50 a month, and you're buying into investments consistently over time. And so as the market goes up, yeah, you buy a little bit higher. The market drops, yeah, you buy a little bit lower. And over time, you dollar cost average your investment to where you get a better price, because you're never going to buy things at the exact bottom and you're never going to sell things at the exact top, right? There's actually an investment bias based on this called propensity for maximization, which is thinking, you look back at an investment chart and you say, if I just bought it down here and sold it up here, I would be very wealthy, or I'd be very rich, whatever you want to say. So you can't do that. We can all look back and say, I wish I would have bought this. I wish I, woulda, shoulda, coulda. But you got to take the knowledge that you have today, and you got to use that to your advantage to think about, where am I going to be 10 years from now, right? Where am I going to be 15 years from now? Because the choices you make today determine that, right? Where you're at today, for the most part, is based on the choices you made 5, 6, 7, 10 years ago. And so the same thing happens in your investment world. So if you want to have some investments, if you want to own different companies, if you want to save money, if you want to invest, you got to make the decision today to start. You got to start somewhere. Everybody was a beginner. I was a beginner, right? I'm still a beginner on some things. Shoot, on this podcast, video, Instagram, Facebook, trying to get information out there to people, compete. I'm a beginner at this, 100%. And so sometimes you just got to put yourself out there. You got to have some blind faith. You got to have some blind faith in yourself, right? So dollar cost averaging, again, is making sure that you are being consistent with your investments and investing in good, solid companies that you can pretty much, I mean, obviously nothing's guaranteed, but companies that you know have a higher than average percentage of being around in the future, right? So committing to putting some money back and saying, you know what, even on a bad day, even on a bad month, I'm still going to invest in this company because I believe in the company. I like the company. What's going on in the market today doesn't really impact them. I mean, think about it. Does the debt ceiling really impact Apple and Amazon and all those? I mean, you should be looking at this going, man, Amazon is about to, deliver a massive quarter. I mean, they got their biggest quarter coming up, right? Christmas. I mean, they're going to be delivering a ton of packages. So you look at some of these things and go, is this really going to matter? Not just 3 months from now. I mean, because this is going to keep coming up based on the history of our political system. But, is it going to matter 3 years from now, 5 years from now, 10 years from now? That debt ceiling talk that I referenced in 2011, I mean, you only wish you could go back and invest during that time. That would have been great. You would have done great if you would have gone back and invested during that time. So really, it's not timing the market. It's time in the market. It's not timing the market. It's time in the market. And you have to get started at some point, right? You got to dip your toe in the water. The water's nice. Come on in. You got to dip your toe in the water at some point. So, and believe me, not to shout out another podcast, but I said, everybody's a beginner. And, I had to stop listening to other podcasts or things. I mean, it's ridiculous. I mean, the amount of competition that's out there for this, for me to think that I'm going to be able to carve out a little piece of this is borderline crazy, really. But a lot of the things I've done have been that way. I go listen, one of the podcasts I listen to is Revisionist History with Malcolm Gladwell. And that thing is so good that, at some point I have to forget that I do this because I'm like, this thing is so good. I would not, like, what am I doing? Right? But that's the way it's always going to be. Whatever you do, there's going to be people that are more experienced. There's going to be people that you talk to and, maybe talk investments with. They're going to have more money. There's always somebody with more money, more investments, more experience. But you got to run your race and you got to compete against yourself. Right? So compete against yourself. Don't compare yourself to anybody else and get started, because at the end of the day, it's going to impact your life. It's not going to impact other people's lives that are your friend. I mean, for the most part, you're going to impact your life, but you will at some point impact other people's lives. You're going to impact your kids' lives, your grandkids' lives. You're going to change your family tree. Your story can be different, right? So don't worry about getting rich quick. Worry about getting wealthy, and worry about doing it in a slow, methodical, disciplined approach, and you'll have much better results. Because what ends up happening to people who try to time the market, Forex trade, sometimes crypto trade, whatever it is, you got to constantly be doing it. You got to find another one to trade. You got to find another one. You got to find another one, find another one. And it becomes exhausting, because if you have some early success, then all of a sudden overconfidence bias starts to creep in. And you start thinking, man, I'm the smartest person I know. And then you take the money that you've made, you put it into one investment, and all of a sudden that's the one that goes bad, right? And all of a sudden you're back down to square one. You don't want to have that happen to you, right? So be methodical, be proactive, and start thinking about, okay, where's some places that I can put some money that I know over time are going to be consistent and are going to help me get to where I want to be. For example, I just made a personal investment this week. I bought more shares of Union Pacific. I think I mentioned that last week that I was thinking about doing that. And I look at that every time I see a train go by, I think, man, that train's making me a little bit of money, right? I'm going to make a dividend off of that. They're doing share buybacks. Commerce is kind of the backbone of this country. And so, the more shares of Union Pacific I have, or whatever railroad you choose, I mean, there's tons out there, go research them. But I see those and I think, man, this is great. I'm not driving the train. I'm not loading the trains. I'm still making money, right? So that's great. So you got to figure out, how do I make money when I sleep? Otherwise, you're going to be working every day of your life, right? So how can I figure out how to make money while I sleep? So think about that. Think about your investment approach. Are you trying to get rich quick? And you'll see that some of the pictures that I used on this is like quicksand, because what ends up happening is you only have so many years, right? So you start making investments that don't work out, makes you want to try to make money even faster because those years have gone by. Don't let that happen to you. Don't let it be quicksand, right? Don't let it be quicksand where all of a sudden you're much later on in life and you haven't put back the money that you should have been saving. So kind of a lot for you to digest in this episode. I hope you enjoyed this. I hope that you can use some of these principles when you're looking at different investments, saying, is this a get rich quick scheme? Are my emotions drawing me in because I see other people making money and I want to be them? Being aware of your emotions will help keep you away from making bad investments. So make sure you're doing it for the right reasons for you and yourself and your situation and where you want to be later on. So I hope you can use this. I appreciate you joining me this week. And as always, I hope you have a great and productive week.